Welcome. Thank you for joining us today. See if my controls will work. Our webinar today will focus on dental practice valuations. Again, we have a few late people joining us. This is the OMNI Practice Group Dental Webinar Series, so thank you all for joining. The webinar is being brought to you today by OMNI Practice Group. OMNI has been serving dental professionals for over 15 years. OMNI has a team of professionals that consists of CPAs, CVAs, commercial real estate brokers, dental practice consultants, dental assistants and office managers, and an experienced marketing staff. Our team of experts is ones that you can trust. OMNI Group is a leading provider of practice transition sales, valuations, consulting, and real estate services. Today's speakers, I'm Kevin Brady. I'll be your host today. And we also have our special guest, which is Rod Johnston, the president of OMNI Practice Group. A little bit about my background. I've been in dental industry for over 34 years. Served in a number of different capacities in the dental field, and have joined the OMNI Practice Group as a broker out of the state of Colorado. Rod Johnston is the MBA, a CMA, and he's also the president of OMNI Practice Group. Rod's background in accounting, finance, sales, and real estate make him one of the most well-rounded practice transition consultants in America. He's also an accredited business appraiser by the Institute of Business Appraisers. Rod, welcome, and thanks for letting us put this webinar on today.
Oh, sure. Yeah, no, I'm glad to be here, and looking forward to educating people on practice valuations.
Just some quick notes on our agenda today. We're doing some introductions right now. I'll have a little quick presentation to go over when in the life cycle of your dental practice that you need a valuation. And then Rod will take a core look at valuations. And again, it's a topic that we get a lot of questions as to when and how does a valuation work. So Rod will take that. We will do some question and answers at the very end. So if you, during the presentation, feel that you have a question, feel free to upload that into the question box. We will not use the raise hand function of Zoom at this point. And we hope to look at probably between 11 and 11:30 finishing the webinar. So thank you again all for joining today, and we'll move into the webinar. When is it time to value your dental practice? Well, there are many different times in the life cycle of a dental practice that a valuation is really appropriate. The first and the most often that we see it is the sale of your dental practice. This is going to help the seller to find a realistic sales price through a reputable valuation broker. And again, I say that because there's a lot of times that sellers will use an accountant that may not have a lot of background with dental to value their practice, and may be missing out on a number of different aspects to really value that practice. The buyers also benefited from having the valuation by having accurate numbers to make decisions to purchase the practice, as well as when they're seeking banking financing. The second reason for having a valuation is selling a portion of your practice. This is usually done when a dentist wants to phase down, but not phase out of the practice. There are, again, a lot of dentists that want to slowly phase out, but not totally. They love dentistry and they want to continue, but are looking to turn the practice over to either a partner and or an associate at that point. It's going to allow you to determine the price now for the practice to work with a partner or associate that wants to buy into the practice. And it determines a sale price that can maximize your sales value. Third reason is future buy-in or buyouts. This is done much like selling a portion of your practice to a partner. It allows both parties to determine a buy-in price now or the total purchase price to buy you out. Tell you a little story is, had a doctor that went to a seminar and came back, talked to me and said, I think I'm going to sell the practice to my associates. He was 56 years old. Talked to his associates. They got the valuation done on the practice, got an attorney to draw up papers, and he sold it to his associates over the next 9 years. At 65, he retired and basically became their associate for one more year. But his comment to me was, I sold it at its highest price. The practice was doing the most volume when I sold it. And I took the proceeds each and every year and invested those in the market. He said it was the best scenario that he'd ever thought he could do with the practice. So if it, again, if you ever have the opportunity and you have associates, look for evaluation and opportunities to do that early could maximize the value of your practice. Fourth reason, excuse me, is financial needs. And this is typically doctors think they have an idea of the value of the practice. If this is going to be, a huge part of your retirement and a critical part of your retirement planning, you need to have a realistic projection of the value of your practice so that at retirement, you're actually knowing exactly what that practice is going to return into your retirement funds. So make sure you do it early and often. And again, a full valuation isn't needed for this. A simplified valuation, or what we call a snapshot valuation, is probably more of a valuation for financial planning needs. The fifth is formation of a partnership. If you're looking to merge and establish a partnership with maybe another doctor and another practice, it establishes a baseline value of each practice before forming the new entity. The original valuation will prove helpful in case dissolution of the partnership or any of the dentists down the road. The sixth reason for having a valuation, and hopefully never, anybody on this call never has to go through it, is a divorce settlement of assets. Valuation will be required for the division of assets. Make sure you're working with an appraiser that understands the valuation methods that are right for you and the state which you practice in. All valuations are not the same. And again, I mentioned earlier in the presentation that some dentists will use, their CPA that may not be a certified valuation consultant. make sure you do. Make sure you find somebody that's certified to provide you with a valuation that fits your needs for your practice. And make sure you develop a plan to transition the practice early. A number of doctors that we have worked with over the years wish they would have done a plan earlier, because they allowed the practice to kind of decrease in production over a number of years. That cost them a lot of dollars down the road. Rod, I'm going to turn the presentation over to you.
Okay.
And
okay. All right. Well, thanks everyone for attending. I put this valuation presentation together over the past couple of weeks. And I've done one before in the past, and the focus was more on the methodology and how to do the calculations. So I think I put a lot of people to sleep. So in this one, I'm going to focus on not only doing the methodology, but also on what affects value from both the revenue side and the expenses side. So it gives you a better picture, and because that's a lot of the questions we get is how can we improve our value and increase it when we're getting ready to sell. So for those of you who are interested in learning how to do valuations, there's several of us within OMNI who are accredited with different organizations. I went through the International Business Brokers Association, and there's also a National Association of Certified Valuation Analysts, and there's another one. I can't remember it off the top of my head, but there's actually 3 or 4 different ones. This is the book we use. It's a very, very easy read if you get bored and want to read it. And my buttons aren't working. There we go. It's just 3 inches thick. So if you want to have a little light reading, feel free to buy the book. It's on Amazon. I guess it's probably $100 or something like that. So, but hopefully you won't have to. Well, not hopefully, you won't have to, because you can work with us or another certified valuation person to do your valuation. So what is a valuation? A lot of people just think it's just the market value of a practice, but it's more to it than that. It's taking a look from a technical aspect of the numbers in a practice. So it's using different formulas, and there's hundreds of different formulas that you can use. So it's just more or less the process of calculating how valuable is your goodwill in the practice, how valuable is your equipment, your culture in your practice. So all those intangibles. The equipment piece is easy. You can go onto Craigslist and see how much you can sell a chair for, but it's really calculating out the goodwill and some of the intangible aspects. And then the other side of the coin is market value. We might come up with a value of $1 million, but we know from a market standpoint, it's probably worth a little bit more than that. So maybe we put the practice on the market at 1.1 million. So that's why whenever we get doctors who are telling us that they're using their buddy who's a commercial broker to sell the practice, we're like, well, you're probably going to cost yourself several $100,000 if it's a big practice, because they don't know the market, and we do. So, and market value is what a willing buyer and a willing seller are willing to exchange a piece of property or a good or service, without either party having any compulsion to buy or compulsion to sell for that particular good. So those two may or may not be the same. That's kind of where we come in as well. We try to get the valuation as close to market value as possible, but there's times when it just doesn't work. There's margins that can affect the value. There's the revenue side, there's location, there's the lack of a lease or because the building may be torn down. So there's different things that might affect that value from a market value standpoint instead of the technical valuation. So we really come together to try to marry those two as closely as possible. And even if it doesn't work on the technical side, we have to look at it from a market side as well. So that's why it's kind of important to use a broker who's not just a certified valuation analyst, but someone who's familiar with the market as well. Rules of thumb. Though that's often quoted to us, just like, well, my doctor's cousin's aunt's sister said it's worth 70% of collections, or 80% of collections, or 100% of collections. It's like, well, that's nice, and that's a rule of thumb. Rule of thumb is just a very general formula that you can put in place to figure out what a value is in a practice. And truth be told, we use that kind of as a sanity check, just to make sure that our valuations are somewhat in the ballparks. If we come up with a value of 95% of collections, or even 50% or 40% of collections, and we know that in Santa Clara practices sell for 90% of collections, we know that our calculations are off or something's missing. So we'll go back and check through the numbers to make sure that maybe they're paying a family member to keep taxes down, paying them to clean once a week, $75,000 a year, something like that. So not all practices are the same. So that's why the rule of thumb doesn't really work. It's like saying all cars are worth 70% of their original purchase price. So my BMW that I drive is worth 70% of what I paid for it, and so is the Yugo that if everybody knows what that is, an old junker car it's also worth 70%. So it's an okay way to do it, but just be careful how you use it. And a lot of people abuse it. We go to appointments often where the doctor said, my banker told me it's worth 100% of collections. And be careful of that as well, because bankers are including the cost of the accounts receivable balance, which is typically a separate sale of the practice. So we're not valuing the accounts receivable in our valuation. We're just focusing on the tangible and intangible assets of the practice. So and every practice, well, most every practice is different. Even the sellers will tell us that. They'll say, well, my practice is different, and usually is. So there's a lot of different things that go into it. So what does affect the value? Is it equipment? Is that really going to give you a big bang for your buck? It's like, I'm going to go buy new chairs, like it's fixing up the kitchen in your house. Are you going to get a dollar for dollar return if you go get brand new chairs and brand new digital x-rays, brand new CBCT, brand new latest, greatest, whatever piece of equipment that may be? The answer is no. Equipment's really not going to affect it a whole lot. The purchase price allocation, when we do that, really has equipment at about 10 to 15% of the total price. So you're not going to get a huge return by purchasing brand new equipment. Unless you're 5 years away, that's when we would recommend that you take a look at the equipment 5 years or so. Then you can get most, if not all, of the depreciation from the equipment, the depreciation expense on your tax return. So that would be the time to use it. How about location? Does that affect the purchase price of a practice? If you're on a corner street with 100,000 cars a day going by, with a gigantic sign that turns around, it's lit by a neon light, and that's nice to have, and it does impact valuation to some degree, because our calculation of goodwill does include looking at the location of the practice, but it's really not excuse me, the biggest portion of the value. So how about staff and culture? Not really. It's good to have great staff, and it shows in the margins when you have a great staff, but it's really not the big thing. The big thing is cash flow, and that's what everybody looks at. The banks look at that when they are going to do their loans. The consultant that the buyer is going to bring along, or the CPA, that's going to come into the office and look at your tax returns and profit and loss statements and all that fun stuff. That's what they're going to look at. So really, as you get near retirement or selling your practice, or if you're not retiring, just selling your practice, and you're a couple of years away, that's really when you want to look at the revenues and expenses in your practice to make them as good as possible. The national average overhead is 65%. So if you get it below that, you're doing pretty well. And we can help you calculate that as well. There's add backs and some other things. So how do you increase the value in your practice? We talked about the equipment side. Increase the practice quickly. If you're a year away from selling, you really can't. It's really hard to do that. We'll go to a listing appointment and the doctor will say, well, you came up with a value of 500,000 or whatever it is. How do I get it to 700,000? Because that's what I need to retire in the next 6 months. And the answer is you can't. So there's no quick formula to it's like getting rich quick. It's luck. So really, if you're a year or two away from retirement, that's the best way to kind of look at things. And banks take a 2 and sometimes 3 year view of your practice when they do the value. They want to see the last 2 years and sometimes 3 years tax returns, especially post COVID. They're really scrutinizing things very closely. So really, taking a 2 or 3 year view of your practice is the best way to do it. So, and it's a two-headed calculation. You have to not only look at the revenue side, how much is coming in, but how much is going out. I've done several presentations where I show $1 million practice that's taking home $250,000 or $300,000, and then we have a $600,000 practice that's taking home $400,000. It's like, well, which one is going to be the most valuable? The $600,000 practice or the $1 million practice? And the answer is the lower value one, or the lower producing one, the 600,000, has incredible margins. So it's taking home $400,000 versus the $1 million practice that's only taking home $250,000. So don't just look at the revenue side, look at the expense side and how things are run in your practice. And I know there's things that impact it. And a lot of you guys have staff that have been with you for 20 years or 30 years. I've had seen staff that have been there with 40, 45 years. They started when they're 18 in high school. And now they're in retirement. So, and I know they're part of the family and it's hard to go to them and I wouldn't recommend that you go to them and say, we're going to reduce your salary, before we sell the practice. But you do want to take a look at things. If you're 5 years out and a staff member leaves and you used to do 1.5 million and now you're doing 1.2 million, but you still have the same amount of staff, consider looking at the staff. And I've had a doctor do this. They go to the other staff members and say, hey, Susie's leaving, or Jerry, whoever it may be. My options are to hire another assistant or to have you guys take on the workload. And if you guys take on the workload, maybe we figure out a way to compensate you a little bit more for that. So, but not as much as what Susie's salary was. So it's a way to keep your expenses down as you're in a practice and going through and getting closer to your to selling. Ways to increase revenues. You can do some more marketing if you're not doing any marketing, and if you have the energy to do that, to get more patients into the practice. I have doctors who are 3 years away from selling and they say they want to ramp it back up to 1.5 million. And then I give them some advice or turn them over to a consultant that we work with and say, well, here's what you need to do to get your numbers back up. You need to really crank up the marketing and really work hard. And then after about 6 months, they call me back, say, yeah, no, I'm good. I don't want to work that hard. It's too difficult to do it. So let's just keep it at 1.2 and go from there. But if you are wanting to get the most value for your practice. You can increase marketing, get new patients. Procedures is another area. If you stop doing endo because you really don't like doing endo, or you stop doing oral surgery, or you don't do Invisalign or one of the orthodontic procedures that a lot of general dentists do, or implants, or some of those types of things. If you want to increase revenues, you can start doing some of those procedures back in your office. Maybe not refer as much out. The other thing to look at is your hygiene program. If you're down below, say, 25%, say you're at 20%, that might be something to look at. A healthy practice should have hygiene at about 30% of collections. So the hygiene revenue should amount to about 30% of total revenue in your practice. And if you're not near that, then that's time to meet with your hygiene staff and your front desk and say, hey, we need to get our hygiene program booked out and get it filled up and really get things ramped up. And there's ways to do that. And if you've never been at 1.5 and you've always been at $1 million, I oftentimes will recommend a consultant to come into the practice and help you get there. And as you all probably know, there's some good consultants that are out there, and there's not so good consultants that are out there. So, ask around and find out who your friends have used. If they've used a consultant, give us a call, give Kevin or myself or one of the other brokers a call, and they often know who the good ones are and who the not so good ones are. So we're happy to help you in that aspect. Decrease expenses. We talked about staff. As I mentioned, many of the practices that we go to sell, especially in the later career doctors who are 65 or over, and they now want to sell their practice. They may have 3 or 4 dental assistants, 2 front desk people, and 1 or 2 hygienists, and they're only doing $800,000 a year. And we look at their staff payroll, and it's over 40% of total collections, and that really brings your valuation down when your margins are really low. So you really want to take a look at that. I know it's hard in this day and age when hygienists are hard to come by in almost all the states that we work in, and even dental assistants in certain areas. I know in Seattle it's hard to find any staff. Because of all you can go work for a big tech company for $60,000 a year and get full benefits, answering telephones versus being a dental assistant or front desk person. So it's really hard to find good staff and keep them paid well. So you got to look at both sides of the coin. You have to look at the revenue side as well as the expense side. And like I mentioned, as you get nearer and nearer to retirement, you can consider looking at your staff options. And then other thing on expenses, look at your rent. You should be close to 7 to 9% of total collections is what your rent, your lease should be. If you're nearing the end of your lease and it's time to renegotiate, you can go back to, maybe you signed your lease at the height of the market. Now things are down. You can go back to your landlord and say, I was at, or I'm at $36 a square foot. My lease is up next year. I'd like to renegotiate that. I'll sign a 10-year lease if you drop it down to the current market rate of $32 a square foot or $30 a square foot. So it's something you can take a look at and renegotiate. And all the OMNI brokers are commercial real estate licensed as well. So we can help you negotiate that. And take a look at that on top of the value in your practice. We can also value your buildings where we can do a broker's price depending on your building. Another thing to look at expenses is, we already talked about this stuff, so is to look at your dental supplies to see where you are with dental supplies and talk to your supply rep about that. So increased revenues. We talked about getting more new patients in the practice. You can do that a number of ways. Social media is really big. I know quite a few practices that are really good at social media. There's companies out there that can help you that specialize in dental social media to get new patients. You know, a lot of the community pages on Facebook, there'll be people out there asking about dentists. So be active in social media is a great way to get new and more patients, as well as some of the traditional word of mouth and other ways. We talked about increasing your procedures. If you don't do endo, oral surgery, or ortho, that's something to take a look at. Improve your hygiene volume and your SRPs, your scaling and root planing. They should be 20 to 25% of your total hygiene program, is what the number that I've seen from many consultants. So if you're looking at your hygiene program and your scaling and root planing is only about 5%, you may want to take a look at that and talk to your hygienist. Efficiency, more patients, procedures in less time. If you're taking 2 hours to do a crown prep, you know, take a look at why you're taking 2 hours or taking longer to do certain procedures. So getting more patients and more procedures in less time. I've seen hygiene appointments in some practices take an hour and a half, and you're like, why does it take me so long? So and practices allow for are allowing for the bookwork for their hygienists. It's like, well, no, it doesn't take that half hour to do the books, to reschedule a patient and to do the chart notes and those types of things. Practice merger, you know, that's one way. In fact, I just did one not too long ago down in California where a doctor was probably 2 years away from selling. There's a dentist down the street, I think maybe 3 or 4 blocks away. He had a really old practice. I think he was in his 70s. He was only doing about $350,000, $400,000 a year. So he approached that doctor and he knew his lease was up and said, hey, I'll buy your charts. You can come work in the practice with me for the last year or two or however often you want. And he got a really good deal on the charts. He was able to increase his practice by about $200,000 just by paying. I think he paid about $75,000 or $100,000 for that practice, and he made $200,000. So not a bad return. I'd love to get 200% on the stock market if I could figure out a way to do that. So maybe Bitcoin. I don't know. So, but practice mergers are a great thing. I think the ones that we've done over the years, we often have the buyers come back to us and say, do you have any more practices near us? Because that worked out really well. On the flip side of the coin, the reducing expenses is the other part of the valuation. If you have too many staff, if they're overpaid, if you're giving them frivolous, incredible benefits, take a look at that and do an analysis on that. Your supplies, they should be 5 to 6% of your total collections. This is your dental supplies. If they're not, you may want to either talk to whoever's doing your ordering or talk to your supply company and say, hey, you know, we're at 9% and why is that? There's some supply companies who will manage your dental supplies in your office for you and do the inventory. And they have some formula that if it exceeds 7%, they'll refund you certain dollars or give you free supplies or something like that. And if you read the fine print, it says, well, that excludes this supplies like implants, that excludes these supplies. So certain things in that contract. So be careful of those types of arrangements. As we talked about, rent should be 7 to 9% of total collections. That's sometimes difficult to control, but just be aware of where you are on the market. You know, I know many of the doctors and practices that we've sold. The doctors haven't looked at their rent expense or even their lease in the last 7 years. So be sure you go back and take a look at your lease and see where you are. If you're above market, you can go possibly renegotiate that. I've even had practices where we were able to renegotiate it in the middle of the lease with 5 years left. So, but also know how many years are left on your lease. 2 years ago, we had a practice where we went, he called us to sell it, and we went and talked to the landlord about renegotiating a new lease for a potential buyer. And there was, I think, 6 months left on the lease. And the landlord refused to do a new lease because he said he was going to tear the building down within the next 5 years. So he didn't want to do any leases. So it went month to month. And he had $1 million practice, and we tried to sell it, and there's no lease. We tried to sell it to some of the practices and the dentist down the street, but they didn't want to pay any type of decent price. They were paying maybe $50 for the patient charts. So he ended up having to move his entire practice about 2 miles away. He lost a lot of patients, and because it's kind of a weird area where there was a busy road that went right between the two, and that's often keeps patients from going across the tracks, so to speak, in order to go see the dentist. So if he would have had a lease that we could have kept intact, we could have sold his practice for probably $800,000, but we ended up selling it for $150,000. So he lost $550,000 on that, just because he hadn't paid attention to the lease, didn't know what was going on, didn't know what they were planning on tearing the building down. And he was already 70 years old. He didn't want to practice another 5 years and build out the new location. So just be aware of that. That'll affect your value of your practice as well. Extracurricular expenses. I've seen, I always say I've seen it all, and something else pops up, but lunches, outings, if you're, I know some practices will keep a full inventory of food in the lunchroom. So just kind of be careful of that. I know it's not a huge expense, but outings, some doctors take their staff to Hawaii or on an annual retreat every year. So watch out for those types of things. And as you get closer to retirement, you want to pay attention to those things, and say, sorry, staff, instead of a $2,000 trip to Hawaii, I'm going to give you each $500. So some way of cutting it back without really penalizing them. And then unused equipment or equipment with leases. You don't know how many of the Zoom whitening machines I've seen in the corner of offices, or unused lasers, or unused CEREC machines, or whatever it may be, and they're still leasing it. They're still paying for the lease. So pay attention to that as well. There's probably, I don't know the dollar amount, but I know a recent practice I was in, I think they were paying $5,000 a month for a CBCT, and they weren't using it. So they weren't doing implants. They were referring out a lot of the procedures. So I'm like, well, why do you have a CBCT if you're not placing implants or doing any major procedures? And like, well, it's the latest, greatest thing. So you have to have it. And that's kind of a mentality you have to push aside and not buy the latest, greatest thing for the last 5 years of your practice. And then family expenses, and these are the family members that you're paying your high school son or daughter to clean the practice 1 day a week, and you're paying them $30,000 a year, or at least that's on paper what you're paying them. Or your wife who's doing the bookkeeping, and you're paying her $75,000 a year, or whatever it may be that you're overpaying some staff just because you want to help them out. You don't need to cut that out completely, but just be sure that whoever's doing your valuation knows about it, because we can add that back into the practice so that it'll make your value a lot higher. So what decreases value? Margins is really the one of the biggest things. Little to no cash flow in the practice. Excuse me. Oops. So there's little to no cash flow in the practice. That's again, where the practice has all those things going on in the practice, with their overpaying staff, their rent is high, they have their family in the practice, they're paying leases on equipment that they don't use. So you really that really will decrease the value quickly. An absent dentist or a short-term associate, this may be a dentist who might have gotten ill, maybe he's got cancer or she's gotten cancer. She's not in the practice anymore. They were doing $1 million. So now we have an associate in the practice. There's really not a whole lot of goodwill because the dentist isn't in the practice. He may or may not be coming back. Recent one I have right now going on is where the doctor had a stroke, and he's currently lost use of his hand to do dentistry, and he's only 60 years old. And he's not in the practice. He was doing 1.5 million. They have an associate in the practice. So, they're doing like $120,000 a month. Now they're doing $60,000 a month, but the family of the dentist is trying to get us to sell it for what the value was based on 1.5. And we're just like, well, that's near impossible because, the goodwill is kind of gone, or it's going to go quickly, and it's been 5 months already. So, we do the best we can to get the best price we can, but, it's difficult when it's a short-term associate who just came in, and they're more or less a locum tenens who are only going to be there for maybe 6 months. The value goes away quickly. And even quicker is the dentist who dies. For some reason, we've had a rash of these recently, which is really sad. A doctor who passes away, the value of a practice can go down as much as 10% per week, because the goodwill is virtually gone because the doctor's not in the practice anymore and he's not coming back, or she. And so the buyer will say, well, there's just a bunch of patients, and patients may or may not have heard about the death. So they're leaving quickly. So you're losing a lot of patients. That's why you lose a lot of value very quickly if you die. So don't die, and you'll keep the value of your practice. A hygiene program is really important in the practice. The value of a practice, buyers and consultants and CPAs will look at the hygiene program in your practice, and if it's not somewhere close to 25%, 30%, they'll try to put a discount on it. It's like, well, there's no hygiene in the practice, so I don't want to pay full value because I'm going to have to build up this hygiene program all over again. Abnormal practices, these might be the holistic practices is one example, that it's kind of out of the norm. So you have a practice that you practice holistic medicine, or you do all the hygiene and there's no hygienist in the practice. That affects the value. There's not a lot of holistic dentists out there right now, and so it's if a large portion of your practice is holistic, it's going to be difficult to sell and take a long time. About 5 years ago, we had a holistic practice that was 90% holistic in downtown Bellevue, which is a really nice area, great location, really nice neighborhood. It was doing about $1 million. It should have sold for $900,000. It actually never sold because nobody wanted a holistic practice. So it sat on the market for about 1.5 years, and he finally canceled the listing, and he's in the process of converting it from a holistic practice just to a normal regular practice, or at least reducing the amount of the practice that is holistic. So if you can get it down to like maybe 10 or 15%, then general dentists can look at it and see that it's now a normal practice. So abnormal practices can decrease value. The other thing is too many welfare patients. If you have a ton of Medicaid, Medi-Cal, just capitation plans, those types of things in your practice, those can really decrease the value of your practice as well. And again, a small percentage is fine. So if it's maybe 5%, then you're okay. But if you're looking at 15 or 20% of the practice is Medicaid, then it's going to be really difficult to sell. High interest rates affects the value. So when I first started being a broker 15 years ago, the average bank interest rate to get a practice loan was about 7%, 7 to 8%. So the higher the interest rate, the lower the value. So right now is a great time to value your practice and to sell your practice and to buy practices, because the interest rates are really low. I know one bank has 1.8% financing. Another bank that we just recently was about 3.25%. And I know a lot of you sellers are jealous, because I'm sure some of you guys, when you sold your practice or purchased your practice, you were probably paid 12 to 18%. And I've heard 24% was one of the highest one that I've heard. A doctor back in the 70s purchased a practice, and they paid 24% interest rate. And the economy also affects value. It's currently a good economy. I know when things slowed down in 2010, there was really nobody buying practices, and there weren't a whole lot of people selling practices either. So the economy does have an impact, and right now economy is going really well. Supply and demand. If there's not a lot of practices on the market where a lot of buyers are looking, and that can be some of the nicer areas, in whatever state you're in. Because whenever we ask buyers where they want to practice, they always name the super nice areas. They don't ever name the little tiny towns in the middle of nowhere. So if you have a practice in a good area, you're going to get a higher value. And speaking of the tiny towns, that's another thing that affects value. If you're in a remote location, you might be doing really well, but you're not going to get 90% of collections. You're going to probably get 60%, 70% of collections. Okay, so that talks about kind of what affects value. Now we're going to jump into some methodology on how we calculate value. So there's a lot of different methods that are out there. You saw that 3-inch book that we went through when we did our our certifications. It was over about a 6 or 8 week period, and when I did it, it wasn't online. This was 12 years ago. It was all in person, and it was a different state for each section. So there's 6 or 7 different sections. So I actually had to, I think, fly out of state 3 or 4 times in order to get it done. It was a week at a time, and we went through that book. And I forget what the instructor had said, but something like 150 different ways to value a business or a practice. So, but really the primary methods that are acceptable. I do the annual practice valuation study group. We have an annual conference every year that we go to, where, believe it or not, we do practice valuations and talk about different things and trends in values. I think, to be honest, I think it's a way just for a lot of the group to get a vacation, because it's usually in Scottsdale, Arizona. Next year it's in Savannah, Georgia, and it's been in Hawaii, and it's been in all these super nice tropical places. So, but we actually do case studies and do valuation. And then the 3 accepted methods that almost all the brokers across the nation use, and others who do valuations, is the book value method, number 1. And that's your value of your assets, which includes a value for equipment plus a value for goodwill. The second method is going to be historical sales, which is the past sales price of practices that have sold in your area, either in your community, if it's a small, densely populated community, and a lot of practices. We track that ourselves. We also have databases that we use, that we have access to through our certification, so we can get that information. And then the third method is the capitalization of earnings method. And that's kind of an investment method where we back out all the salaries for the doctors, if there's an associate doctor owner and the associate doctor. And then we put back in what a market rate salary would be for a dentist. And to calculate out what that return would be on their investment. So the first step in valuing a practice, is to determine, why is the practice being valued? That does affect the value, if it's for a sale, if it's for investment, if it's for divorce, if it's going to be whatever means or a reason that you're going to value the practice, we need to take a look at that first and foremost, and especially if it's a partnership, because that adds a level of complexity. We do recast the financials, which means we add back all the non-financial or non-operational expenses into the tax returns and the profit and loss statements. So that family member who you're paying to $75,000 to clean the office 1 day a week or 1 day a month, we're going to add that back into the net income. So instead of having net income 100,000, you might have 175,000. And also that's going to be the travel that you take to go to your continuing education course in Jamaica, your car that you're running through the practice, all your Costco office supplies that you're buying, your toilet paper to use at home, or your vacation cabin. So all those different things we're going to add back into the practice to determine an adjusted, oh, that's odd. Sorry about that. I don't know why that's off. So that just talks about those things that I mentioned. So those will all be added back into the practice, or normalized all your expenses. So if your office supplies is at 7% of total collections, we'll bring that down to like 1.5% set. I think that last one is alimony payments. I did actually see a practice that had alimony payments underneath office supplies. So they were running it through their practice. So going through the methods here, the first one is going to be the book value method. So this is going to be the value of your equipment plus the value for your intangibles. The first we do a value for goodwill, and I'll talk about how we calculate that out in the next slide. And then we do a 3 months supply of dental supplies, 3 months inventory. And then we add in a value for equipment. And this is typically taken from your depreciation schedule. So we can see all the equipment that's currently in your office, when you purchase it, how old it is, and we get a book value for that. If that's not available, we might either have an equipment appraiser come in and look at the practice, or we'll do it ourselves. Most 4-op practices that are more than 10 years old, the value is typically going to be, $50,000. It's not a huge value for the equipment, unless you just bought a CBCT last year for $150,000, which will add the $150,000 back into the practice. So that's the book value of the practice. So that calculation for goodwill, that's based on the net income in the practice, and it can range from 75 to 200%. We look at a lot of different variables to determine what that percentage should be. And that includes the location of the practice. We talked about that location with the big sign and the 100,000 cars that go by every day. So that would increase that percentage. If your margins are better than the national average, that'll increase the percentage. If you have 500 reviews on Yelp and Dr. Oogle and whatever other reviews are out there, we'll look at that. That improves it. If there's not a lot of reviews and they're negative, we know that that most patients don't write a whole lot of great reviews sometimes, so we'll throw those out. So we scrutinize that. Technology in the practice. If you, I recently listed a practice that didn't have a computer, didn't have any technology whatsoever. They used the old book method, the charts to actually do the scheduling. It was like I turned back the clock to 1970, I think. So if there's not much technology, then we reduce the percentage. And marketability of the practice. So if the practice is going to be an easy sell and we have 5 buyers tomorrow for that practice, we'll bump up that percentage. So it's they always say valuations it's an art, not a science. So we kind of try to get it as close to a science as possible and as close to a math formula as we can by coming up with our own methodology using these things. And we have our group has done probably 500 some valuations over the 15 year, or probably more than that now, probably closer to 700. We've done a lot. So we were able to really determine closely what that percentage should be. Method 2 is historical sales. So these are past sales that have occurred in the community. Maybe if it's a densely populated area, we have a pretty good database. If it's downtown San Francisco or downtown Portland or downtown Dallas or a downtown area, we'll probably have a pretty good idea of what that practice historical sales would be. And it's kind of like a rule of thumb formula. So it takes the weighted average of the last 3 years collections. And we do use a weighted average, which is 3/6 of the current year, 2/6 of last year, and 1/6 of the year before. So that's how we come up with the weighted average. And then we multiply that by a percentage. And that percentage is also based on your location and historical sales. So, and that's from our past sales that we've done. It's also from the National Association of Certified Valuation Analysts has a database. There's a database called Pratt Stats that we get information from. We get it for free because we enter our information to it and they give us the information back. So, so we're able to have historical data. The third method where I lose people is the capitalization of earnings. So I try to make this as simple as possible. So we start out with adjusted earnings, which is, again, it takes the net income from the tax return. We do all those add backs to the practice net income. So that gives us the adjusted earnings. And from adjusted earnings, we backed out the owner's salary and the associate salary. So now we're going to add the market salary for an associate doctor, which in most areas, that's going to be about 30% of the collections for the general dentist. And that's the doctor's collections. That's not the collections of the practice, because remember, there's hygiene built into that number. That's going to give us discretionary earnings in the practice. And from discretionary earnings, we're going to divide by a capitalization rate, which it's similar to commercial real estate, where there's a cap rate for medical buildings, there's a cap rate for apartment buildings, those types of investments in different properties. In the business acquisition world, there's also a cap rate for excuse me, for dental practices. And we have the reference guide. And again, based on our history, we're able to do that. And it's 20% for general dentists generally. It's somewhat of a risk factor. If it's a practice that might have a lot of Medicaid in the practice, or if it's a remote location or some other factor that causes it to be a higher risk, we'll bump that up. It's also higher for specialists typically, because specialist practices are built around referral sources. If the doctor leaves and they're used to getting referrals from all their general dental friends within a 5 or 10 mile radius, the new buyer typically has to start over and try to win those guys back over. So that gives us a higher risk. So that gives us a capitalized value for the practice. So those are the 3 primary methods. And then from there, more often than not, we take a third of each value, a third of the book value, a third of the historical sales value, and a third of the capitalized earnings value. And that gives us the final practice appraised value. We can adjust those 3 if we have more confidence in either the book value, historical value, or the cap rate method. We'll adjust it to, we might say, hey, the book value is probably more accurate. So we might put that at 50% instead of a third. So we can adjust that accordingly. All right. So I'm going to walk you through a sample. So take a big chunk of coffee and we'll try to get through this. So so on the left-hand side here, we have the adjusted net income. So we start out with the collections from your tax return, and we use 3 years tax returns, and expenses from your tax return. That gives us the net income that came from your tax return. So now we're going to do the add backs. We add back the owner's salary, which is $100,000 from the tax return. This doctor traveled a lot to go to continuing education, so they had $25,000 in travel that we add back. We found office supplies were super high, so we added $25,000. The wife's doing the books, and she's getting paid $50,000, so we're adding that back. into the practice, or maybe she's getting paid $100,000 and $50,000 is the market. So we had $50,000 back. So the add back total is $200,000. So our adjusted income is $400,000 in the practice. So we went from $200,000 on the tax return to all of our add backs. The true amount that the doctor is receiving is the $400,000. The other things that he's buying is just some of the benefits he gets from the practice. So we jump into our method number one, the asset accumulation. So we're going to start out with the book value. That's for the equipment. That's from the depreciation schedule on your tax return. So we add those all up and we come up with $50,000. Now we're going to calculate the goodwill. It's a decent practice. It's in a pretty good neighborhood. He's got pretty good reviews. Demand for the practice is okay. So we came up with 150% as the multiple for the net income. So we see that arrow that shows right there, the goodwill or the adjusted net income of 400,000. We're going to multiply that times 150% to give us $600,000 over here. So we add those two together to get an asset accumulation value of $650,000 for book value. Method two is very simple, historical sales. We had that $100,000 from collections, just bring that down here. Historically, practices in that area sold for 70% of collections. So that gave us a historical sales value of $700,000. The third method, the cap rate, we took the adjusted net income of the practice, 400,000, which there should be an arrow from there to there. And then we backed out what we would have paid an associate, excuse me, in the practice, which this was, we took a percentage of this because it's not all doctor collections and it's some hygiene. So we multiply that by 30% to give us 270,000. That gave us excess earnings of 130,000. And it's a general dental practice, so we use 20%. So that gave us a capitalization value of $650,000. So those are the three methods. So I'll let you take a picture of that if you want to real quick. And then from there, we go on to the combined final value, an asset accumulation value of $650,000. We just weighted them all equally, 33% for each one of them. And we came up with a final value of $660,000. So we would then take that 660 and sit down with you and talk to you about the market and whether or not that makes sense or whether it might be pretty close to where we should be. So we might say, why don't we start the price at 690 or 700,000? And oftentimes the buyer will want to negotiate. So we'll start a little higher just to leave room for negotiation. A popular question these days is the impact that COVID's had on the valuations. For the most part, when we first came back from COVID, banks didn't know what to do. So we more or less took charge and decided for them what we were going to do. So we averaged out the expenses and the revenues for the year. So if there was 2 or 3 months of shutdown, we backed out if there's any revenue expenses for those months. And we put back in what the average revenue was. And we were using 2019 numbers for revenues and expenses. So we basically just smoothed out the year in 2020 to make it look like a normal year and ran it by the banks. Banks were all okay with it. So that's what we've been using. So it's as if COVID never happened in the practice. And a lot of the practices that we're working with, their numbers are actually pretty close to where they were, if not higher, in 2019. So patients came back. Banks are gaining confidence that the patients are all back in the practice. Nobody lost all their teeth during COVID. So patients still have teeth and they need to be cleaned and fixed. So, and banks are seeing that. There's a couple of the banks are lagging behind and they're very skeptical. They are scrutinizing practices more. They're asking for a month-to-month profit and loss statement, month-to-month procedures for 2020. And they're comparing that to 2019 just to kind of see where things are. Buyers are also coming back. 2019 from March to June, we were more or less twiddling our thumbs because buyers were a little scared of coming back to a practice with no patients. So they didn't, and it was slow there for a while, but towards the end of last year, it started picking up, and this year we're probably as busy as we've ever been. So we've got a lot of buyers looking for practices. All right, now a little test. Now that you know valuations, when should you sell? This is just a graph I put together of doctors who are getting within 5 years or so of selling their practice. And this early part, the first 1 through 4 is kind of the early part of their career. And maybe over the next 10, 20 years, they're in this peak of about 1.2 million per year. So when do you sell? You don't sell during this period, the first part of your career. And you don't sell when you're going down, which unfortunately is probably 40 or 50% of our practices seem to decide to sell when they used to do 1.2 million and now they're doing 800,000 or 600,000. It's like, well, there's this rule that when you sell your practice, they don't take your license away. So the best time to sell is when you're at your peak. We often talk to doctors about harvesting your equity, and when you're 2 or 3 years away from retirement or selling your practice, or even if you're mid-career and just decide you want to do something else, or you don't want to manage a practice anymore, you don't want to manage the staff headaches, the insurance companies, the pandemics, and everything else that comes along with that. Why not sell your practice now and either be a dentist, associate dentist for someone else. There's groups buying practices. We could find an investor who might want to buy a second location and maybe employ you back in the practice at 30% of collections, or whatever number that might be. So why not take out, if you don't owe any money and your practice is doing 1.2 million and you can sell it for $1 million or 900,000. Why not take a look at that, especially when they're talking about possibly raising capital gains rate and ordinary income rates. So that's something that we'd be happy to sit down and analyze for you and talk to you about to see if that just that makes sense. So hopefully I didn't go too quick. I see we're pretty on time. So any questions?
Yes, you do have some questions, Rod.
Yeah. So yeah, is AR included in the valuation? No, it's not. That's a separate calculation, and AR is usually sold with the practice. We almost always recommend that the seller sell the AR and the buyer purchase the AR. And there's 2 formulas for that. One is to sell at 85% of the collectible amount, which is everything under 90 days. And the second formula is a tiered approach where the AR is sold. It's 90% for all the current AR, so 0 to 30 days. 31 to 60 days is 75%. 61 to 90 is 50%. And everything over 90 is either 5% or it's not sold at all, because everything over 90 is usually not collectible unless there's a payment program of some type. I'm selling, I'll let you take this one, Kevin. I'm selling to an associate. Do I value it now or when he buys the practice?
I would suggest that you have, and again, it depends on when the associate is going to purchase the practice. If it's going to be now, definitely. If it's going to be in a short term, I think evaluation would be good to do now so that you both know exactly where the practice value is as you go forward.
And to be fair to both the associate and the seller, I mean, the associates come to us and tell us they're buying a practice, maybe 3 years from now. The associate doesn't want to pay for the equity they built in the practice. So we try to structure that where they split the equity that's built up over the next 2 or 3 years. Next question, my bank told me my practice is worth 100% of last year's collections. Why wouldn't the banks know what it's worth? Yeah, banks can be, they're speaking bank language. When they say 100% of collections, they're probably talking about the accounts receivable. But banks don't do valuations. So practices typically don't sell for 100% of collections. So I'll just make that blanket statement. The ones that do are rare. Overhead's 50%. It's downtown San Francisco. Huge sign. Staff is awesome. Just everything's perfect. Then you might get 100% of collections. Otherwise, you're looking at somewhere less than that. So I think the banks often are calculating out the accounts receivable in the practice. The value paid for the accounts receivable. How do specialty practices differ from general dental practices? For some of the specialty practices, it's a completely different calculation, especially for orthodontics, because there's contracts involved. It's almost like a manufacturing company because it's a 2-3 year process where it's a percentage of completion. So your ortho case might be, if you're 12-month into a 24-month term with your patient, we would take that contract and maybe apply a 50% value to it because it's 50% complete. So it's 2 calculations for orthodontists. For specialists, we tweak the value for the goodwill. It's not as high because the specialist is going to disappear and not have those referral sources. So there is a difference between it. And make sure if you're working with a broker or someone who's valuations, they know that, or they have experience doing it, because it can be a little bit more complicated. I just bought a new cone beam for $159,000.75 is the value of the CPC on top of the valuation. Kevin, you want to talk about that?
Well, I think you mentioned that is that if that cone beam is basically purchased, yes, it could be added into the equipment. But again, if you're selling a practice or you're thinking about selling a practice, very short term, and you're thinking that you'll get the full value back on the CBCT, you may not get it totally all back. So within 5 years, you're probably going to get the depreciated value, and then it will become part of the equipment asset.
You want to take this last one too, Kevin? Is a rural practice worth more or less than an urban practice?
A rural practice is going to be less than a urban practice, and it's typically because of the demand for the buyers is typically going to be in the urban areas. And I think Rod mentioned it, there's certain demographics that are basically weighted higher for demand than a rural location. So the value will, instead of being maybe close to 90 or 100%, and maybe for an urban practice, because of its location, it may be more in the 70% range. And I think, Rod, you mentioned that earlier.
Yep. All right. Let's see here. All right. Thanks everyone for attending. We have a special offer for everyone. We're going to do $500 off practice valuations and a free transition planning consultation. So if you want to do a practice valuation, just let us know. And we normally charge $1,500. We'll take off $500 for that. And we'll also do a free transition planning consultation. If you're a couple of years away from selling your practice and you want to get the maximum value, we can talk to you about that. We can steer you towards a couple of consultants that we work with. And we can kind of benchmark where you are today and what you need to do to grow your practice to sell for maximum value in a couple of years as well. So Well, I think that's it. Thanks everyone for attending, and hope you're all in warm states and not in Texas or some of those places that don't have power. So if you are, stay warm.
Rod, thanks for your time today, and thanks for letting us put this on.
You bet. All right. Have a good day.
Bye-bye.